we're making them cash flow. They're getting their tax deductions. Like it's actually a win-win for everybody. And that's really what you got to look at it, right? We have the time and the systems in place to do this. And then, and they want to get into real estate and they want to be a passive investor, which ultimately I think should be everybody's goal is, right? I would much rather just hand my money to somebody and them hand me back more than me have to go find these deals and do the rehab and right. So, I mean, yeah, we're providing a service. Yeah.
That's the huge key. The value that you bring as a syndicator is that you are taking all the time and you're putting the whole entire deal together. What's going on, guys? This is Dan Wynn.
Mike Glassman.
And welcome to the Military Cash Flow. Today we have two very special guests. We're doing a four-way today. We got Chris and Ashton with Valkere Investment Group, and they're just crushing in the multifamily space. And please, would you mind kind of telling us a little bit about yourself and what you got going on? We'll start with Chris first, and then we'll go over to Ashton. That's good with you guys.
Sure. So like you just said, we're brothers. We started about 2 years ago. We jumped into some duplexes, and we really partner with other investors and other people's money, and we started our first deal that way, and we've been scaling ever since. So I'm based out of Phoenix, Arizona. I'm an IT engineer by W-2 trade, and I was in the Air Force for 4 years as a firefighter, so I switched totally. And then 2 years ago, we started getting into real estate and investing, and we've been scaling ever since.
Yep. And my name's Ashton, older brother. Like you said, 2 years ago we started, but coming up on 20 years in the Air Force as a pararescue jumper. We just wanted to get into real estate because, looking for that next step. I didn't want to have to work for somebody else for the rest of my life. So, retiring now after 20 years, it just made sense, start our own business. And I think the timing was perfect. I was getting out, and my brother had brought up that he was, tired of it too, and he's watching his 401k dip, so it kind of, we both, it just made sense for us. And started 2018. We've been crushing it, like getting after it ever since. So
you said you guys started in 2018?
Yes.
August. Yeah.
2018, you guys went from duplexes all the way up to real estate syndication in like less than 2 years.
That's correct.
Wow.
It's been fun.
That's fast. That is fast. So tell me, what was some of those items that kind of triggered that initial site? So you said, the 401k started dipping. You guys mentioned being tired, but what was the conversation like? I mean, a firefighter turned IT and a 20-year Air Force vet decided, let's do this.
Yeah, I think we wanted more freedom, right? We really wanted to be able to travel. We've done a bunch of trips together as brothers and family, whether it was Europe or Costa Rica or, different trips. And we wanted more of that freedom to be able to go, well, this month, hey, we're going to check out and go surfing down here or go do a snowboard trip up to this resort or whatever. And just have that ability to take away time and do that. And we weren't really seeing that. Additionally, like you said, my 401k, in IT, I'm putting away 10%, put away 6%, like they tell me to. And then all of a sudden I see it drop by like $6,000 in a month, for no reason. And I was like, oh, what the heck, man? Like, I need a better plan long-term.
And I think right around that time we started just getting into, I know you were reading a lot on Bigger Pockets, Chris was, and then I read like the 4-Hour Work Week, and and you just kind of like, what am I doing? Like, there's so much more out there, and I think, my grandpa said one time, he's like, you don't ever really retire, you just get a new job. And so like when you read that 4-Hour Work Week, I was like, man, if we could do that, then you can just, you could pull out, get assets, get something that's making money. Yep. Yeah. Great book. So there was that. There was a bunch of things that just kind of clicked. I mean, Chris had mentioned he was, getting on this place called Bigger Pockets, and somebody had mentioned that to me 2 years ago. And so I got on there, and it just we just started snowballing, and we made like I'm very goal oriented. I know my brother is too. And at that point I'd heard something about that 90-day sprint, 90-day goal. And I was like, let's get some under contract within 90 days and try and close. and we didn't know what we were doing. We put out terrible offers. I mean, I put out terrible offers, and
extreme ownership.
Yeah. Well, luckily, the bad offers didn't get accepted, and we had people helping us out on the way, and that's really what, if anything, building that team and that network that really helped us be successful in the beginning, that was clutch. So.
That's excellent. I love what you said. Your was dad, or maybe it was your grandfather that said you don't really just retire, you just get another job.
Yeah, granddad.
I love that. I'm gonna start using that now. But that mentality, like that, kind of what we learned growing up is, hey, just like Chris was saying, invest in your 401k, invest in stocks. Don't really talk too much about that passive income as far as real estate and the different advantages to real estate that it has over regular stocks. I mean, you're talking about you put money into an account, and for reasons that you cannot control, you see a big stock and you see a big dip in your account. That's got to kind of hurt a little bit. But I love the fact that you guys set those goals, and then you're like, hey man, let's put something under contract in 90 days, and you started getting after it. What were some of the things that you did to prep yourself for that?
Well, I know I'm very, very much, goal oriented, like I said. So when I make a goal, I dive right in. And so, and Chris is the same way. I mean, we started crushing books and podcasts and just, how can we do this? How can we do this? And we knew what we wanted to do. We wanted to create that passive income. We want to create that second, third, fourth stream of income. Right. So, we really we set that 90-day goal, and we started reaching out to people. First mistake was we reached out to a real estate agent who had no idea what investing was. And, but she did find our first deal. I can give her that, but she didn't know anything about investing. But my brother found a property manager on Bigger Pockets, and that really helped out. So, I mean, we could go into that first deal if you want, but there was a lot we learned in that, just throughout that whole thing. So.
Absolutely. I would love for y'all to, but right before you guys get into that deal, what was it in your childhood that kind of created that, hey, let's go after it. Let's fight this thing to the end, dig into all the books, dig into all the podcasts. What about your childhood kind of created that mentality for both of you? Because it's very common. So somebody did something right in your parents.
Yeah. They'll never listen to this.
Yeah, no, I think it's true. We did have a very disciplinary father. We both got a couple slaps growing up. And I think he would just really drill home, doing something and doing right and following through. So a big part of that was like, we had to clean up the house and stuff, and we got slaps if that thing wasn't done to a certain level, right? And it was a very disciplined household, and that was good. It had, it had its own downsides, of course. I'm not saying go out there and slap your kids, but I will say it kind of enforced, if you're going to do something, if you're going to go clean the kitchen, if you're going to go clean the garage, you're going to go do something I tell you do it correctly, do it all the way through. Don't just do it halfway. I think that stuck a lot with us. Part of it, of course, is the military. They're very big on, not cutting corners, because you cut corners, you can affect the guy next to you. So I think it's, it goes all the way through life. We kind of had that disciplined approach growing up and through our careers.
I would also point out that, being brothers, we're actually both very competitive. And so, Chris would analyze a deal, and I'm like, well, I got to analyze the deal. So I'd analyze the deal, and I'm like, well, I got to put an offer. And then he'd put in an offer, and then and we just keep bouncing things off of each other. And, you don't have to be brothers to be like that. But if you do find a counterpart that, complements your personality and your work style and everything, which, I'm sure we'll get into, but Chris and I are completely opposites as far as a lot of that goes. So it was really, I think that's compelled us to succeed because of that. So, yeah.
It's funny you say that, because I noticed as soon as you introduce yourself, you're like, yeah, I'm the older brother. I'm an older brother. Too. I'm an older brother myself, and I do the exact same thing. And my siblings are always like, why do you got to say that? Like,
that's exactly what I was thinking.
I've never said that before, though, have I?
I don't think you have. That's
a little bit of that, like, hey man, older brother, so. So let's jump into that first deal, man. Let's hear about it. What, how do you find it? When we talked about, you said you found it through your realtor, but like, what was the analysis process like? What, break that down for us a little bit.
Yeah. So we initially, when we decided we want to get into real estate, the first thing we did was found a realtor in Raleigh, Durham. And, she started sending us properties, and we said we wanted a duplex up to a quad. And, so that went for a while, but you don't know what you don't know, right? So we were talking to her. Again, she was not an investor. She didn't understand, what value add was. She didn't understand how we can actually get ahead like this. So she's bringing us stuff that, she thinks we'd want to live in, really. But that was our first mistake, although, she did find us 2 duplexes right next to each other. So we bought those. We put an offer in on those. And I think it was for $209,000 for the 2. Is that right? Yeah.
Wow.
Yeah.
For both duplexes?
Yeah.
Yeah, but yeah. So, and it was through a wholesaler. Yeah. It was through a wholesaler. And
they're pretty run down.
Yeah, so they're pretty run down. So we knew there was value add. Absolutely, there's value add. There's only 1 tenant out of the 4. And I should say there was actually 3 people living in this 1 bedroom, 1 bath. And yeah, it was rough. It was a rough neighborhood. But here's the thing. So the neighborhood was up and coming. So there were homes being sold for up to $600,000 right down the street. So the plan going in was to burr it, and I'll let Chris get into how we raised the money and everything, and then we can go into how we follow through, I guess. But Chris, you want to go into that?
Yeah. So like I said, in our very first deal, we wanted to go into that approach of partnering up and leveraging other, not only experts, attorneys and contractors and property managers, but also leveraging other people who have capital but don't want to do some of the management. Yeah. So I actually had a coworker who, wanted to get involved in real estate as well, but he was kind of like leaning on me to get more of that knowledge and more get the management down. And so I presented him, hey, if you come in with 70% of the capital, we'll do all the renovations, we'll do all the deposit, we'll do a joint venture, and I'll give you a deed of trust, and here's the attorney showing this document. And I kind of, made it all secure and made it a good partnership. And he came in and we were able to take down that, for $209,000 cash for those 2 duplexes. So that gave us a lot of advantage over other offers. Then we were able to put in the $95,000 for renovation. So it was like $42,000 each. It was a big lift. There was a lot of wood flooring that had holes in it and stuff.
No plumbing.
Yeah, the plumbing was all jacked up. So, wow. But when we did that, we bought it for $209. We put $95 into it, and then it appraised at $480 at the end. So 2 duplexes, $240 each now. We got a loan for $336, and if you do the numbers, $336 basically got all our capital out. So, and that was even with all the interest to the private loan for 7 months. Yeah. So it was good. It didn't really cash flow super well, but It was a good entry into understanding, how all these numbers work and how to work with another private lender or capital raiser.
So you guys didn't just buy like a turnkey single family home. No. You guys bought the most beat up in the roughest area with the most work.
Yeah.
And you guys actually made it work. So that's pretty impressive.
It's funny, yeah, you say that because it was pretty beat up, and we didn't know that at the time. But when the contractors tell you, "Oh, all the metal's been stolen, all the scrap metal," like, what the hell are people stealing the scrap metal for?
Copper under the
AC well, like everything that they're doing through the renovations too. Hey, we found a shotgun underneath the crawl space. Really? What the hell's this? Okay. It wasn't there last week. Okay, that's even worse. What's
I'd be like, it's mine now. Bring it over.
Yeah.
Oh man, it even goes even better. Our 4th tenant we did rent to, so we got it fully leased up. We put the 4th tenant in, and a good guy. We did credit checks, and all of a sudden, a week later, he was shot and killed, unfortunately, in another neighboring city. So sometimes, like we had that was an intro property, and we had a good number of issues and challenges that we worked through, and it taught us a lot. So
that's awesome. You guys covered a lot in one deal. That's a really good entry point as far as that education process goes.
Yeah.
So how did that deal transform from 2 duplexes doing a burr strategy with private money into this whole real estate syndication? What was like the next step for you guys?
We actually did 2 more duplexes after that, but everything was with partnering with other people's money. So we kind of already opened that door, and that gave you insight into what you could do, right? I think a lot of people get hung up on, I don't have the money, so I got to go wholesaler, I got to go flip first off, right? Yep. Which is not a bad way to start, obviously. I mean, people do great things doing that. But because we were able to open that other people's money door early, it kind of opened that whole spectrum of what is possible. And then so, and I think not a lot of people talk about this on podcasts, but building the credibility and the knowledge base to be able to go up to people or have them come to you even and want to partner with you, because they know they have the money, but they don't have the time or they don't have the education to do it, right? Or they don't want to take the risk, which understandably so. I mean, a lot of people have other things going on, and I get it. But that's where we excelled. And I'm going to take my hat off to my brother here. As an IT manager, he was really big on building up our profile online. And so getting the LLCs, getting the website, getting the social media up, that kind of stuff. And that really does bring a lot of credibility. And people talk about it, but I don't hear about it too much on podcasts. And like, if I was to talk to somebody new that really wanted to get into it, that's what I would say. Like, really, get into the education of it, learn, but also create that digital footprint, right? So when somebody looks you up, you meet somebody, everybody gets business cards, but do they have a website? Do they have, something that looks credible? And then you can talk the talk, and then you can also have that online that everybody looks you up nowadays anyway, right? We're all borderline stalkers on Facebook and on, but it's so easy. That stuff's so free. You can do that, right? And by doing that, and people seeing what we were doing, we showed before and after pictures, and of course that builds credibility, and it just snowballs. You get that momentum going.
Yeah, I love that. I love that, because you're right. It's not talked about too much. I think, at least not on air. Me and Mike have talked about that several times. And I've talked with other of my investor buddies that are doing great things in the real estate space as well. And a lot of it is building your credibility. So I love that you leverage some of those resources that you're talking about. Like, hey, I'm an IT specialist. I can get this, I can get the online portion ready. I can get the social media looking good. I can get our website nice and clean. And all that does is provides more confidence in those people that would invest with you, right? So they're confident in your abilities to actually execute the deal, and you're not going to screw them over, right? So I think that's that's great. What are some of the other things? So you talked about, you build your website, you're getting your social media up. What are some of those other things that you're doing to build your credibility?
Networking. Yeah. Go ahead, Chris. Go ahead. Yeah.
Well, networking, but I would say a big part of credibility is who can you partner with and liaison with, and then show that partnership to other people. So that big part of that first deal was talking with my attorney and then getting this private lender on the phone. Hey, let's talk through this joint venture with this attorney. And when people hear things from someone who is an expert in the field, it adds a layer of credibility that you as a new person might not yet have. And you can do that with a property manager. You can do that with a contractor. You can do that with the attorney. You can do that with a real estate agent. If you bring in someone who has that expert and they just add that sense of warm, fuzzy feeling to someone who's about to invest with you a bunch of capital. If there's someone else saying, oh no, we do this all the time, there's a bunch of people doing this, and here's all this legal documentation why it'll work and why it's secure, then I think it adds a high level of credibility to any new investor.
Yeah, that's absolutely right.
Big time. Taking those people in your network that you're already working with and basically having them speak for you, right? I mean, yep. Yeah, that's phenomenal. That's phenomenal.
And I'm going to tell you guys, some of the listeners here don't know this, but I've actually worked with Ashton and Chris in the past and helped them with some deals. And I mean, everything they're saying is I'm learning more about your guys' past now during this podcast than we have in real life. And everything that you guys do is done to such a level of professionalism and preparation. Like, not once would I have ever doubted that you guys weren't prepared, to purchase a property or anything. So, I mean, what they're saying is very, very true. And from being on the opposite side, I've seen the benefit of everything that they're dropping here. So that's awesome stuff.
Well, thank you, Mike. I really appreciate that, man.
Yeah, it's been a pleasure.
Yeah, we got more to do, right?
Yeah, we do. We got a lot more to do.
Yeah.
So now what some people also don't realize that you guys are clear across the country.
Yes.
You guys are not together, and the places that you're buying properties aren't necessarily where you guys are living. So speak to a little bit about that. How is this long distance, out of state real estate investing going while you got multiple members of a team? Who's kind of taking the roles and responsibilities, the whole nine?
Go ahead.
Yeah. So yeah, initially I was stationed in Fort Bragg, but even then, at the beginning, most of our properties were in Raleigh, Durham. So leveraging that team, I think, was the big one for us at first, to give you the comfort, or give us the comfort and the ability to be able to do that. Right. And so, we crushed a bunch of those books that everybody reads in Bigger Pockets, and one of them was Long Distance Real Estate Investing by David Green. And that just clicked. And so making those relationships with the partner, with people such as like the real estate agent, with the property manager, contractors, lenders, so on and so forth, that really worked out to our benefit. And again, just leveraging their expertise and them knowing that, we're trying to do deals, they wanted to work with us. Right. So that made sense. And then, Chris can talk more into how our business is set up so that we were able to effectively, and efficiently take down deals, even though we're across the United States. I think you can talk better to that.
Yeah, it's a challenge. I mean, there's so much technology out there now that you can do this, which is pretty awesome. But, just starting out, we had our property manager sending video, right? Of okay, here's what's going on, here's what this looks like, or pictures. Okay, well, where does that video and pictures go? Okay, so you make a process. Okay, hey, drop them in this Google Drive that you now have access to, and now I can grab them whenever I want to see them. You just find those pieces of working remotely that are a challenge, and then you find a way to fix them and get around them. Some of it you'll learn in books, some of them you learn through trial and error, but there's so much technology and applications out there, and so much ability to schedule meetings and work around schedules. We use, Google and G Suite, and we set up a weekly cadence, a weekly meeting for our company to come together. And it was our family. Initially, it was just me and Ashton, but setting those check-ins per week and setting those refocusing on our goal and refocusing on the project, addressing a big part of ours was Traction. We read Traction.
Oh, yeah.
That was a great book. And mainly because what it does, it sets up the meeting is really nice, where it talks about you're going through, okay, here's the updates. And then a great part is issues. There's an issues part where you just go through, these are things that aren't working, and then you hit them. You address those in the meeting rather than put them off or, ignore them, because they're just going to come up again. So having that weekly meeting, weekly cadence, coming up with a process and system for the challenges you face. It's a big part of growing a business, and it worked for us.
Yeah, I would go one step further, saying that Traction, if you are looking at starting this as a business or anything as a business, Traction is a great place to start, because it will give you the framework on how to set your business up. And not only that, so it gives you the day-to-day, the week-to-week, but it also gives you what a lot of people, I think, kind of miss in the beginning. Is like, where do I want to be in 5 years and 10 years, right? And so then you're working back from there, and having that big goal, that big, hairy, audacious goal, like at the end, that you're working towards, and then setting up those 90-day sprints to get you to that first year goal, to that third year and fifth year, and so on. I think that's really key. And I'm a big picture guy. My brother's more detail oriented. So like understanding how that work together, you understand the roles and responsibilities of everybody that you need on your team. And that's another like really big point, right? And anybody that's been in the military understands how a team works, but translating that into your own business can be a struggle sometimes. Like if I turn around and tell my wife that, she's too IC or whatever, I'll probably get cussed at or something, I don't know, but yeah. So.
Yeah, man, I love how you were, a lot of the books you're mentioning, it sounds like, you're talking about systems and processes, right? I mean, that sounded exactly like a lot of Tim Ferriss's stuff. And you guys are actually putting that stuff to action. So can you speak to some of the things that are helping you, helping your system along, or helping your system run smoothly, like maybe some of the apps or some of the, some of those little things that you guys are actually using? You mentioned Google Suites, you mentioned, a couple of Google platforms, but what are some of the other things that's really helping your business just gel right?
Sure. I wrote a blog on this pretty recently, so it's pretty familiar. But I'd say anyone who's going to get into business, Google Suite's probably the place to start. It's got so much good stuff. You got your mail, you got your calendar, you got your Hangouts for free. That's like Zoom or Meet. And then you got, a note taking in there and whatever. You can set up a Google Voice, so you don't have to give people your personal cell phone. I mean, all that stuff is pretty free. If you go up one level and you get the business plan, you pay a little money. But other things we use, JotNot's a great one on the phone for signing documents really quickly. We use Monday.com now for project management. It's a little pricey, so maybe you do that later on down the road. We use Slack. Slack is free for communication, meetings, or quick chat, throughout the day. And then we do have Zoom. So we do use Zoom for our weekly cadence meeting, just because it's got the nice background stuff you can do now, and everybody loves that. But what else are we using? Let's see. We started with Airtable. Airtable is a great, massive cloud Excel spreadsheet type thing. It's completely free until you get to like 1,500 records, it takes a long time. We never hit it. But we used it to track massive amounts of data that we were taking in. So, all the numbers and all the offers, and now we're doing it with Monday.com. But I mean, you kind of pick the one that you need when you need it, and then work on it. If it doesn't work, toss it, move on, find another one that works for you and your business. Right now, we're getting more into the apartment syndication space. So we've dived into Syndication Pro for an investor portal. We are now using Mixmax and Pipedrive. Mixmax hooks with Gmail, and it just allows for email templates and scheduling emails to go out at certain times and sequences. If they do this, what happens? And then I'll probably go too fast. I'm all in IT, but
I was literally just thinking, I could see Chris light up about IT while Ashton's over there just like, all right, I'm done with this.
That's pretty much how it goes. I've tried to get him to use the tools, and he's like, wait, so where is this?
Yeah.
but it's a good balance. We got a good balance, which is nice. So I'll go too in the details, and he'll pull me back, and nice balance.
I love it. You got to share that link. Make sure we get that link so we can put it in the show notes so other people can see the link to that blog. Because a lot of times on the podcast we kind of cover over some quick overarching themes, but sometimes getting that detail like that to help perfect other people's systems goes a very, very long way. So thank you so much for sharing, and we'll make sure we get that into the show notes as well. So.
Absolutely, because you hit on a few different things there, Chris. Like many people, for example, you like something very particularly for your systems. And many people say, well, if they're doing it and they have success, then maybe I should do it. But you hit the nail on the head. You have to find what works for you. I can throw a rock and hit 1.5 million different project management software systems, CRMs. CRMs are a dime a dozen. You have to find the ones that are most user-friendly for you, and then just make them work. And the same thing as in the whole hiring process. You're kind of slow to hire, quick to fire. Same thing with those systems. Kind of try to learn them.
Yeah.
And you realize they don't work, get rid of them. Move on to the next. It's good stuff.
Phenomenal. All right, so the real estate syndication. All right, let's jump into that a little bit. All right, let's talk about that first syndication and why the jump. What switched in your mind to be like, all right, duplexes, we're done with duplexes. Let's do something a little bit bigger.
Economies of scale, right? And risk management. And I mean, there's a whole score of reasons, right? Everybody wants to go bigger, but it's got to make sense. And we understood, duplexes. We understood quads. That makes sense. You can do a residential loan, but then we started looking at the loans you can do for bigger properties, and they just look better and better. And then we were already familiar with using other people's money, so we were comfortable with that. So I think right around the time my brother read Best Ever Apartment Syndication book. Yep. By Joe Fairless. Yeah. I think he started that one, recommended it to me, but right around that same time, so our wives actually quit their jobs and work for us. Well, not work for us. I never say that.
Watch out. Hey, delete that.
Yeah. Work with us. Right. And they're department heads of different areas in our business. And right around that time, I think Jamie, Christopher's wife, she manages all the finance. And I remember she said something like, why are we doing these small properties because we were looking at another duplex. And she's like, it's as much trouble to do the duplex as it is to do something bigger. And we had I think we had a 5 unit and a 13 unit under contract at that point. And the 13 unit was actually with 5 Pillars with you, Mike. Yeah. And that just made sense. Like, why not? Why aren't we going bigger? There's less risk. If we take a vacancy on a 13 unit, it's a 1/13th, or whatever. And I'm terrible at math, but you know what I mean? Like, like instead of a duplex where you lose half the profit when you take a vacancy, right? So that just started to click, started to make more sense to us. And then seeing how Joe Fairless did it and starting to see all these other people, how these other people are doing it. And I think I'm a big believer in, like, if I see somebody else do it, I know I can do it. That's just like, it can be done. So we just got to figure out how to do that. But so long as you believe you can do it, you will find a way. And that's kind of where it started for us. Chris, do you want to weigh in on that at all? I mean,
no, I mean, that's pretty much it. It was always kind of our goal to go bigger. We set a huge goal even from the start. We're like, we're going to hit 150 units this year, and we had 1 duplex. Like, it was like, we're going all in. And so we kind of knew we were heading the direction of apartment syndication. That's why we started with private money. We didn't think it'd get that fast into it. We kind of pictured it a little slower and come to that realization a little, making mistakes along the way. But yeah, you kind of spoke to all of it, all the economies of scale, the depreciation that you can get from all those benefits. And then, I mean, now that we're looking at these larger properties that we have, we're kind of thankful we didn't go flip 10 to 15 single families and have those one person lose their job. And now you have that rent to cover for those 10 single families versus, maybe half of your tenants are paying in a apartment complex, and it's a little easier to bear. So it's come full circle, I think.
Yeah.
Go ahead, Ashton. I don't want to cut you off. Go ahead.
Yeah. The other thing I was going to say too is, like, when you understand the valuation, how they value multifamily, it just makes so much more sense. We can force the appreciation. We can force the equity by upping the rents. Like on a 100 unit, if we raise the rents by $25, you've increased, like, the NOI enormously, right? Whereas if I could put like $100,000 into a home, but it's never gonna be valued at over 20% of I don't know, Mike, you tell me, but over
whatever
like 20%.
Your next door neighbor is.
Yeah, exactly. Yeah. So you kind of, which is good and bad. I mean, if you don't put a lot of money into a small property and then it's valued because there's a nice one next door, is good. But as far as multifamily, that just makes sense. We can, by increasing the NOI, all we have to do is decrease expenses and increase, income.
So for those who aren't capturing that, the NOIs is the net operating income. Essentially, that's saying all of your gross income minus your expenses, and it's annualized. That means for the year, what your NOI or your net operating income is for the year. Now, with commercial real estate, just as Ashton alluded to, if you increased your rent at $25 a door, your expenses don't really increase that much, but now your income just increased. You see that you now increased your NOI. Now imagine $25 a door for 10 doors. Now $25 a door for 100 doors, or $25 a door for 500 doors. That's the economies of scale that they're talking about. Now, before we get into those numbers, there's one thing I just want to touch on. You mentioned that your wives quit their jobs. Yeah. But you guys just started syndication. So what was the light bulb for them to say, you know what, I'm going to go all in, and because it's teamwork, right? They don't work for y'all. Yeah. We are going to run this business together as a family. What was that about?
What was that about?
Well, I was getting out of the military, so and we were going to move. I was going to move my family across the U.S. to where I was going to retire. Well, separate and move to. And I wanted to get this is kind of long-winded, but I wanted to get my daughter into school, so we moved them early. So my wife was going to quit her job anyway. She was a teacher, but she quit. So she quit last summer, and at the end of the school year for whatever it was, last May. And so she started picking up slowly into this. But so that was kind of the catalyst for my wife to quit her job, was that we were going to move anyway, and she was going to have to. And she knew that we kind of knew this was the route that we wanted to go, and I kept kind of putting that bug in her ear, like, hey, I'd love you to work from home. I'd love you to help out, because she's very detail oriented. She can do project management, but she couldn't envision that. So we had to kind of slowly open that door, and let her want to work into that position. But yeah, having her quit her job was kind of a culmination of a bunch of different things. And then Chris, I think probably had a similar.
Yeah, I mean, it was interesting. My wife was the HR director for the Hyatt, so she had a really good, high-paying job. We did have a kid, right, probably around the same time we bought the first duplex, so it was great timing.
Yeah.
And we tried the whole working. She was working and didn't like being away from the kid for so long, and so she quit her job as more of a personal kind of decision to be closer to the kid. And then just being around us as we were doing this real estate, I did the same. I kept throwing podcasts and books and, hey, check this out and look at this. And she's really good with management and finances. And so it kind of made sense. They came in and fulfilled needed roles. And we, since we all had this similar goal and similar reason for doing it, we didn't have to, I guess, pay someone else to do it. It allowed us to scale really quickly because now that gave me and Ashton time to do other key roles, and we didn't really have to onboard anybody. So it was a great asset. It was good timing. It was more of, I think, a timing and personal decision than it was come work for us, or we're making so much money, you can quit your job. It was more of an emotional, personal decision that worked into the business. So.
And I would add too, like, with any business, you need to have a vision, and that's what gets everybody on board, right? And that was the thing. Chris and I had been discussing this for a while. Was like, we wanted that passive income, that freedom to take vacation when we want, freedom to work when we want, to pick up the kids when we want, that kind of stuff. And conveying that to our wives was a big factor in getting them on board, because they could see, like, yeah, that could work. We can do this. So.
And man, now you guys are creating wealth as a family, which is phenomenal. That's absolutely phenomenal. I love that. Love that. Yeah. So moving into the actual first syndication, since we talked about how we got there, right? All the things that led up to it. Now we got our wives working with us, right? And we're all building wealth as a family. So that happened, and then move into that first syndication. What did that look like?
So we had closed on a 13 unit with Mike with 5 pillars. And then we started looking into syndicating. We knew we could do it. We started building up that, those soft, investor lists, really. So to decide how big we could go, how many people would want to work with us if we were to get a property under contract. And so we started reaching out to a lot of different friends and family and stuff like that. And then my brother started talking to the lawyers, seeing how we can do this. And I think that's a key point. So we didn't just say, hey, we're going to syndicate. We first figured out how much we could, put an offer in. Like, what is our starting point? And that builds a lot of confidence when you do that, right? Being able to know that your plan is backed up by capital. So that was the first thing we did, was start those conversations. And I'll plug another great book. I met him once, but it means nothing really. Raising Private Capital by Matt Faircloth. Yep. And that's a great place to start, just to understand how to build that relationship and how to start those conversations. And again, that allows you to know how much you can raise. Although I would probably subtract 25 to 50% of everybody that says they will do it on that first one. But that is the starting point for syndication, right? That's a starting point for any other people's money if you're going to work with other people.
We kind of plugged in the roles that we needed. My wife does all the finances and all the taxes and the legal side of it. And then Ashton's wife does the property management, the contractor management side of it. And then me and Ashton kind of took the investor relations and acquisitions portion of it. And so we were able to just really focus on our own roles. And we knew, okay, well, we have this amount of capital from our connections so far. Let's put an offer on this property, because that's about 35% of that property, which is typically what you need for something like a syndication, for down payment, renovations, all that. And like he said, we probably had half of what we thought go somewhere else. It was the holidays, so it was the holidays last year that we were raising for this. So that's a difficult time to do it as well. But just building that network, building the soft commitments, having the roles in place, reaching out to the people that are going to support you in the effort, and then learning from the books, but implementing those strategies. You know, the 35%, that's Joe Fairless move. It's right from the book.
Yeah. And I think, and I'm not sure if you guys want to get too much in the details, but the other thing would be, Mike or Five Pillars and us had a relationship. So I think you trusted us from, closing on the 13 unit, which allowed, confidence in bringing a property to us. I mean, I imagine that's what happened. but yeah, so like building those relationships, I think are very key. And again, that goes back to the credibility thing, building up that credibility by asking the right questions, by networking, by, building up your online, presence and stuff like that. So, but yeah, when you brought us that property, I think our initial offer was like in the 800s, but we ended up buying it for like 950. So, and again, like in this whole process, we never had this conversation, but we leverage every relationship we have because we're not the experts. Like you were the expert on that market. You're the expert on that type of property. And so we really leaned on, your expertise and your opinions on a lot of that stuff. And that's how we kept the dialogue going. And that's how we were able to, I think you came back with like, yeah, he's not going to sell it for any less than this. And we're like, yep, those work and let's do it. That worked for us. So, again, yeah, relationships, networking, and leverage other experts. So.
I love it. And one thing that you guys hit on, I think that really established confidence for you guys as investors is that 35% straight out of Joe Ferris' book. You're right. It is. Yeah. But it comes to be proven true time and time again. I always tell people, I don't care if you're buying a turnkey property or not. If it's an investment and they tell you that it's a 25% down payment, add on an additional 10% for anything else. 35% is what you need liquid at all times. So that's beautiful. And then your ability to kind of, I don't know what was raising private capital from Matt Faircloth or whatever, but establish those relationships, have those people call in, have your attorney have your back and be able to formulate whatever it is for you. And then being able to understand the confidence in this is my max price point, right? I'm going to start here because it's going to make it a great deal. But at the same time, if the deal works, I'm going to give it everything I got because I know what I can afford to syndicate this for. And that just changes the entire game when you guys are going in for acquiring property. So.
Yeah, absolutely.
You proved the concept with a 13 unit, and then Mike through leveraging your team, Mike brought you another, or Five Pillars brought you another deal in the process, right?
Yep.
Where you guys at with that one? Is that your most recent one? And how far along the stabilization period are you with that right now?
So we closed on it. Yeah, we closed on it in January, middle of January, I think it was. And we've been slowly rehabbing every unit that comes available. And I think a key point in that is just understanding how many vacancies you can take and still meet your requirements, the cash flow, right? So we're slowly rehabbing each unit.
How many units?
It's 16 units.
Okay.
So it's it's a small multifamily, if you want to think of it. Like a lot of people say you don't need to syndicate, those kind of properties, but we did, and it worked. So
it all adds to your credibility, right? That's more
right.
Concepts. Yeah. You're proving that concept to your investors, who then are going to probably go and invest with you more, right? So there's always a positive in that piece, and I mean,
absolutely,
right, yeah.
And I think a big lesson there. I mean, there was a bunch of lessons in that one, but Chris, you want to talk about the offering we used?
Yeah, we did a 504 offering, which most people
not very
aren't familiar
popular
with.
Yeah.
Usually people do 506B, Regulation D, 506B, 506C for syndications, taking private capital. But so we did it for what a 504 does. It lets you take different chunks. It doesn't have to be, certain amounts. You can do whatever amount they want to do. The hard part gets to be that it's very state regulation specific. So if I take money from someone in New York versus taking money from someone in Texas, you have to file specific forms in each state. And so it can be very tedious. So it's actually a little more expensive. You learn what you don't know, I guess, as you're going through it. And it was a recommendation from an attorney, so we went with it. and it worked. We're changing our strategy now. We're doing 506Bs and 506Cs going forward. So yeah, it was an interesting learning experience.
And when you have a bunch of military and friends and family across the U.S., it can be a pain. Like, you wouldn't believe how many military members don't know what state their residence in.
That's true. I can actually believe
the taxes.
That. Yeah. So, Chris, go in a little bit into the details between the difference between your 506B and your 504.
Sure. So 506B, you can take unaccredited investors as well, but you're still going to have to file per state, but it's kind of like a flat filing. So you're not going to have to. You'll see when you do a 506B, you're going to have a specific fee per state wherever the investors are, but you're going to have to, it's like a flat fee versus in the 504, it could be a varying fee and you might have to wait for the documentation to go before you can accept the money from someone. But typical for a 506B, 506C, they're going to be accredited investors. So you have to make $200,000 as a sole job earner from your job, or $300,000 if you're a couple. And in a 506B, you can take 25. Is it 25 unaccredited investors?
I think it's 30.
Is it 30?
I think it's 30. Yeah.
Yeah. So you'll be limited on how many unaccredited investors you can take. But
we are not syndication attorneys.
Always consult. Yeah. The main difference, I think, really is are your investors accredited? So are they making $200,000 or more? Or do they have $300,000 as a couple, or do they have a net worth of $1 million? Then they fill out a form and they're basically certifying saying, I am accredited as best to my knowledge. And so that way you have that form if ever anything goes down. With a 506B, you don't necessarily need that unless they want to state that they are accredited, and you're going to be, needing that form if they're going to state that. But typically 506B, you're going to be unaccredited. 506D is more, you're going for that accredited investor, those bigger pieces, and proving that net worth. So.
High level stuff there. And that 506B is less expensive than the 504, just based off your general experience?
Yes. And typically, I think, from what I've gathered with these, I've quoted a couple different security attorneys. Don't say that, but, different calls. Mainly like a 506B could run you anywhere, and it will depend on the raise. So depend if it's $1 million raise, $1 million to like $5 million will be the range. Those will be like $12K for a 506B. If you got a great deal, it might be down $8 to $10K. But for a 504, typically they're going to hit you at $15,000, simply because they got that extra work of calling up the state, finding out the additional research behind each state. And it can be a little tedious. Like for example, we did take money from an investor in New York, and not only did we have to send paperwork and ask to basically take money from an investor in New York, but we had to wait until it was approved, and then we had to find out, we have this additional cost that's going to come up. It was like $1,200, another fee. But we found our attorney worked with us, and we found a way to get around that. And all that is research, though, that they have to do per state. So if you have 50 states, it could be pretty expensive. So they're going to charge you $15,000 for like a 504. And I think partly too, if you're a newer syndicator, you don't know that necessarily, and they're safeguarding you. They're doing their job. They're acting as an attorney. They're saying, okay, I don't want you to risk worrying about if they're accredited or unaccredited, or if you have 25 or you have 30. So I'm going to give you a 504 so you can do your business, but I am going to charge you. So it's partly, work with your attorney. They're not there to rip you off, of course. Right. I had other attorneys I talked to. They said, I don't know anybody who's doing a 504 now. I don't know why you would do a 504. Yeah. So, that was our experience. It's not necessarily the one, I recommend, or could be your experience.
That's good stuff, man. And so that's a super high level. And you know what? I guess what we never did in this episode was actually explain what real estate syndication is, right? We just kind of went straight into it. But essentially, real estate syndication is where you guys, as the investors, you're pooling together other investors' money to fund or to raise the equity portion of a purchase, meaning like the down payment. And so the loan comes in on the backside, then you guys own it. And then over some time frame, you guys have a strategy. What's your general time frame as far as your strategy to pay back your investors?
So right now we're working off the plan. This is kind of a tried. I mean, this is the plan that you hear most people doing, and this is we cannibalize this off of other people as well. But purchase the property after 3 years, looking at a refinance to recapture about 60% to give back to our investors, at least 60% of their capital. If that doesn't work in the numbers, then it's not a deal we're going to invest in, for us anyway. And then usually looking at selling in around year 5 to 7, somewhere there. So
you guys are doing returns throughout this whole entire process. Did you guys maybe do, I don't know, like 30% for the general partners, 70% for a limited partner? How did you work that piece out?
Yeah, for this one we did 30-70 split, and then was a 9% preferred,
8%.
8% preferred return.
Give me back my 1%.
Yeah, and then yes, we're providing. I say the asset is providing cash flow for obviously all the investors every month. And then, during the refinance, they'll get a lot of their capital back. And then of course, at the sale to get the rest, and then, 30-70 split on the profits. But the whole time, we're making, we're making them cash flow. They're getting their tax deductions. Like it's actually a win-win for everybody. And that's really what you got to look at it, right? We have the time and the systems in place to do this, and then and they want to get into real estate, and they want to be a passive investor, which ultimately I think should be everybody's goal, is right. I would much rather just hand my money to somebody and them hand me back more than me have to go find these deals and do the rehab, and right. So I mean, we're providing a service. Yeah.
That's the huge key. The value that you bring as a syndicator is that you are taking all the time and you're putting the whole entire deal together. You're making sure property managers are getting paid. You're finding them. You're hiring people for your business, making sure the team is meshed together. You guys already talked about how you do your weekly syncs, right? So you guys are doing all the back end work. And at the end of the day, you're able to pay your investors back. They're making that money pretty much regardless of what you're talking about. 8% preferred return, which is, that's preferred is pretty, that's really good. And then on top of that, once everything is done, after the 3-year hold, they're getting 60% of their capital back. At the 5-year hold, I'm assuming, they're after they add everything up, the IRR, the internal rate of return, is probably what, like 15, maybe higher.
Yeah.
So you're talking
about 13 to 15. Yeah.
Yeah. So whatever they're putting down, all the money that you're putting down as an investor, you guys listen to this. If you're thinking about investing with some indicator like Chris and Ashton, then that's exactly what you're getting. You're getting the overall 15% of return on your money, and you really didn't really deal with too much, So that's plus all the other tax benefits that Chris was talking about. Those the depreciating the asset, the I don't know. There's just so many benefits with it. It's just amazing. So it's awesome that you guys are able to provide that value to others out there. So, yeah.
And that's the one thing I like the most is that you guys, everybody's fear, I guess, for raising money is well, how do I convince them to invest with me? Right. Yeah. But what you guys are literally doing is providing them an opportunity that they're not going to find in many different places. And then you're showing a track record of your recent successes to show this is my credibility, but here's the opportunity. Yeah. And so it's a really good point to kind of, again, just a place of confidence, because you know what the asset is. You know what you guys can provide.
Yeah. It's also, people see that too. This is something I can touch, I can see it, I can look it up on the registry of deeds, I can, check the tax records. Whereas, stocks, I don't know if Elon Musk smokes a joint on Joe Rogan's show, that's going to take my stock dive.
Yeah.
You don't have as much control. You can't tangibly touch the stock. So, it's a big part of it.
Do the limited partners get this is more of a opinion-based question, but do the limited partners get to walk around and use this asset as clout for their criteria as well, just in your experience?
Yes. Yeah. That's just kind of how the syndication world works. I mean, if they have their name on a deal, a lot of people get to say like, yeah, I'm a limited partner in this many units and I'm a general partner in this many units. A lot of guys start like that. And that's and we offered a couple guys, like friends of ours, that wanted to learn how to do it. Like if they want to sit in on a meeting, or if they want to go over how we're structuring it, or how we're managing all the people that are working on it, that kind of stuff, like absolutely do that. Right. And I know a lot of people start off like that. That's a great way to get into it too.
That's the biggest one that I always hear, like people that are trying to get into syndication. Everyone says, hey, go be a limited partner. Go be a limited partner with a group that's willing to work with you, that's going to allow you to actually go to the job site and kind of shadow what they're doing. Obviously, they're using your money, so you're kind of paying for an education, right? I'd say that's about 20, 30, 40, 50 times better than a college education, Yeah. That's just my opinion. But yeah, that's definitely a way to go for sure. Be a limited partner first, learn the ropes, and then you can go and now you have a system, and you know how to be a general partner. You can you can be the capital raiser and do everything as a general partner would. Yeah. So.
And one other thing I'd point out too is not only does it build credibility when you put all these systems in place, when you do all this stuff and talk to your expertise on it, as that snowball gets bigger and bigger and you're doing more deals, not only bringing in credibility to investors, but you're showing credibility to other larger, syndicators. And that's huge, because now you can talk to people and they're going to teach you, right? Like, what do you want to know? You guys are doing awesome down there. I hear you're doing great stuff. And this is something we're getting ready to partner with a bigger syndicator just for that experience, but also to help him close on a couple properties. But that will, like you were saying, Mike, we can add those to our portfolio, because we're going to be part of that project. We're not going to be managing everything, but we will be part of that project. And so that's huge, not just credibility with your friends, family, investors, whatever, but also with other people in the space. And partnerships, man, they will accelerate your growth so fast.
Absolutely.
Excellent. Hey, so we touched on a bunch of great topics here. We talked about, your first duplex, that transition into real estate syndication, how you're managing your team, some of the systems and processes you guys are using to manage your business. Just to wrap it up a little bit, right? So if you guys had one piece of advice that you would give to someone that is trying to replicate what you guys are doing, trying to do what you guys are doing, what would that advice be? We'll start with the older brother.
So I'm a big proponent of action, taking action. I'm action-based everything, right? I'm that guy that will jump and figure my parachute out on the way.
PJs.
Yeah. And one of the things I found in doing this was, take action. That builds confidence, and that can mean anything from taking action can mean anything from writing down your goals first thing in the morning to making an offer, or to raising that money, or just to reading a book. So as you take that action, it builds that confidence. Confidence builds that competence. It's like being able to actually do something. And then that competence will allow you to get stuff done. It'll build that traction. It'll build you'll start networking. People will start reaching out to you because you're the subject matter expert. So I think it all starts with taking action. And where you are in life, you just got to figure out what kind of action you have to take. But so long as you're clear on where you want to go, what you want, that next step will be apparent.
Yeah. Consistent action. I think it's a big one. I just talked to a guy the other day about, recommending how to get started and how to do all this. And I think a big part, of course, Ashton will go in the take action right away. I'm more the educate, find someone doing it, copy them, take action, and if you just like do that, and then you rinse and repeat, so you learn from your mistakes and you do it again and you do it again, but you never stop taking that action, you're never going to fail. There is no failure, right? And we say it all the time, and Ashton coined it a bit, there's no such thing as failure, really. If you just keep taking action, eventually you're going to get to whatever goal you're trying to get to. You may not get it on the first time around, but if you never give up, then how can you ever fail? So
nice. Very insightful. Good stuff. All right, guys. So now all these people have listened to your guys' story, and now they want to invest with you as limited partner so they can grow their portfolio and their expertise. So how can they get in touch with you?
Sure. So we have a website, and you can put it in the show notes, but it's www.valkeregroup.com, VALKERE group.com. We got all our social media links at the bottom. you can go there to find us. Otherwise, we're on Instagram, Facebook at Valkere Investment Group. But yeah, those are the best ways. And just reach out. We have Calendly setups on there where you can schedule a call, and we'd love to talk and network. Even just to talk real estate. I talked yesterday with two guys, just nothing. We're not advertising. We're not, selling anything. So if you want to just talk real estate, we're down for that as well. All over Bigger Pockets as well. Both our names, you can look us up.
Yeah.
Excellent. Thank you guys both for coming out. We really appreciate all the knowledge you guys dropped and the insight, some of the personal and challenges that you guys had from maybe transitioning out to, bringing in the family and all that good stuff. So for all of our listeners out there, please reach out to them. Just see what they're doing, right? If you guys want to learn more about syndication, by all means, reach out to them and see if they can help you out. And as always, if you guys are watching on YouTube, you know what to do. Go ahead and push the like button, subscribe to the channel, leave some comments below. Let's say, what kind of questions do you have on syndication that maybe these two can help you out with? If you guys listen to the podcast, we need those 5-star reviews. I know that's 10 stars, but go ahead and give us a 5-star review. Subscribe to the channel as well. And for those who are not aware, we do have a Facebook group, the Military Cashflow Facebook group, and we have grown very quickly over the past couple of months. And in that group, we have many active and retired servicemen and women who are in all stages of their journey.
No, that's it. Hey, thanks so much, guys, for coming out. Really, really appreciate it. So with that, this is Dan Wynn.
And Mike Glaspie.
Signing off.